Hello, and welcome to Financial Triage. At the end of this series of classes on Tuesday nights, I hope you will know how to organize your financial life, reduce your lifetime taxes, save money to reach your goals, grow your net worth, protect your assets and your loved ones, give more to the causes that are important to you, and structure your assets so that when you are gone, the people and charities that are important to you are provided for. We are going to cover a lot of information in each episode. As everyone is in a different place financially and has different values and goals, not all of this information will apply to you. You can download the slides by using your camera app on this QR code, which we will show periodically during this broadcast if you miss it here. Important note for those of you that are here in the audience, bathrooms are to the back through the kitchen. As we are going through these topics, if there is a particular segment, topic, or situation that you would like to see as a future seminar, please leave it in the YouTube chat or email the organizers at academy@bedfordpresbyterian.org. My name is Jennifer Climo, and I love all things financial planning and income tax. I have been providing income tax advice to individuals and small businesses for over 30 years, and I've been providing financial planning advice to individuals and couples for over 18 years. I am a certified public accountant, CPA, and a certified financial planner practitioner, CFP. The views expressed today are mine alone and are not the views of either Bedford Presbyterian Church or Milestone Financial Planning. Nothing you hear today should be considered investment advice. Do not make financial or investment decisions based on this or any other seminar, but instead meet with a qualified financial advisor regarding your specific goals and financial circumstances before making financial decisions. Note that almost all financial decisions are going to have a tax consequence, of an income tax consequence or an estate tax consequence now or in the future. So tax consequences should be evaluated before you take action. And most importantly, past performance is not a guarantee of future results. Enough of the disclaimer. Triage, assigning priority order to projects based on where your resources can be best used, are most needed, or most likely to achieve success. Triage is an acronym I created for this series of classes. T is taxes, R is retirement, I is investment, A is asset protection, G is generosity, E is estate planning. Many people find finances overwhelming or intimidating. So I've come up with this structure to help you get started. This doesn't mean it's the only way or that a different solution might not also be an appropriate one for your financial needs. We will be taking questions at the end of each session. You can enter them at any time during the session in the YouTube chat, or if you're in the audience, raise your hand at the end during the question and answer time, and we'll go through some questions. Does God hate money? To the contrary. There are many references to working, investing, and money in general in the Bible. Both in Hebrews 13:5 and 1 Timothy 6:10, the Bible states that it is the love of money that is the problem. There is also the parable of the bags of gold, or talents, told by Jesus in Matthew 14:30. To summarize, a master, God, gave his 3 servants, people on earth, different amounts of gold, money, to invest. The ones who invested were rewarded, and the one that responded in fear and buried the gold was punished. One of the lessons from this parable may be that fear does not make good investment policy. Importance of professional advice. Everyone has different goals and is in a different place financially. Be careful taking financial advice from friends and neighbors. They may have different values, goals, and resources than you do, and what is right for them may not be what's right for you. Most financial advice has tax consequences, and I suggest you find an advisor who's able to help analyze how your financial planning decisions will impact your income or estate taxes. In general, I suggest you avoid complicated investment products. They're usually expensive and may have unnecessary or unexpected complications. Most people aren't in the highest tax bracket, and they don't need ways to shelter a lot of income from taxes today. A good rule of thumb is to evaluate the expense of the investment compared to the value you are getting. If you have to hunt to find the cost, or if there's a multi-year penalty for getting out of the investment, then it might be a good idea to really analyze the decisions why you are buying it. There may be other, simpler solutions that can accomplish your goals without as many complications. We will get into more specifics about these topics in Week 4, investments, and Week 5, asset protection. Values. It is very important to identify your values, what things are most important to you, and then align how you spend your money and your time to those values. For where your treasure is, there your heart will be also, Matthew 6:21. Take some quiet time with a blank piece of paper and write down what concepts are important to you. For example, if spending time with your family is most important to you, but you spend 80% of your time working, or on activities that do that, then you will likely be happier as your values and time are aligning better. However, life isn't this easy. Often you have competing values, and you have to balance your time between them. Where you spend your time and your money indicates what you are valuing now. If you aren't happy with that answer, then you can work to change that. To figure out your values, start with your values around money. How did you grow up? Did you have money as a child, or were you poor? Did your parents teach you anything about money? Our childhood influences our adult selves in a lot of ways, and these things stay with us all throughout adulthood. I have seen adult children of people with a lot of wealth who were never taught about money. So when they went off on their own, they kept living the life they had lived with their parents, which they couldn't afford. If you teach your children about money, you can really help your kids in life, give them a step up. For example, in general, even a child that grows up in a stable home with money will have to start their life after high school or college at the bottom of the work totem pole. It takes years to build up the resources to pay for their parents' lifestyle. So they shouldn't go out after graduation and try to live it. Also, your children's goals are probably not the same as yours. A personal story. My daughter bought her cell phone, using her birthday money. Cell phones are super expensive, and we weren't going to pay for the whole thing. She also earns $20 a week for doing chores, but she has to use her money to pay for her phone and clothing beyond a certain amount. Her favorite place to buy clothes have now become thrift stores. As parents, we'll offer to pay some number, $10, $15, something, towards each item, and that she has to pay the rest, which is great when she wants a pair of $75 jeans, because I'm not on the hook. Another story. When I was 16, I couldn't wait to buy a car and have independence from my parents. I don't know that my daughter shares that same goal. Cars are expensive to purchase, insure, fuel, and maintain, and she would rather use her money for other purposes. There are no wrong goals. Goals are very personal. Generosity can be a value, giving your time, talent, which are your skills, and money to those who are not as blessed as you. There are many other values around family, kids, and finances, such as, should I pay for all of my children's college costs if I can afford to? How long should I let my kids live with me? And what costs should we pay for versus them? Your values will influence your goals. Next, we get to goals. Lots of people like football. No football team ever won the Super Bowl and said, I have no idea how we got here. Same is true with building wealth and achieving any goal, really. The football teams planned their game strategy, came up with contingency plans, executed, followed up, and repeated. You must have a plan, and the plan starts with goals. Goals should be written. You won't achieve your goals if you don't identify them, and it's easy to forget, so take out a notebook, put down your goals. Determine what is important for you to achieve, set a deadline, and write them down. Some people find it helpful to post them in a place where they see them all the time, because all your actions should support those goals. I love whiteboards, as you can see. At home, we have a whiteboard, much smaller than this one, where we write down our goals in the order in which we want to achieve them. We're often erasing, rewriting, etc. When my son was small, he asked me, "Mom, who's Al?" I always have very messy writing, and there was a space between the go and the owl. So now we call it the Go Owl board. There are no wrong goals or values because they're very personal to you. Here's just a few examples for financial goals. Pay off my mortgage before I retire. Reduce the amount of stress in my life by next January. Very specific, it's got a date. Increase the pledge to my church by 2% of my income every year until I am tithing by January 1st, 2026. Very specific with an end goal. Eat out 4 nights a week. Very specific. We'll get to the numbers shortly. You will notice that your goals are influenced by your values. Next, assign dollars to your goals. We're going to go through an example. I apologize for the busyness of this slide. This is going to be an example of how to achieve a goal, and the goal is eating out 4 nights a week. So this is a couple, married couple. They want to eat out 4 nights a week at $80 per occasion. 80 times 4 is $320 per week, or about $1,300 a month, give or take. How can they achieve this goal? I know this example is not representative of everyone. Please bear with me. During the questions and answers, we can go through other real-life examples if anyone wants to throw me some numbers. Also, there are a lot of concepts, known as jargon, throughout these classes that we will explain further as we go through the material. If I use a concept or word that you don't know what it is, please ask in the Q&A, because that means someone else doesn't either. Back to our example. One parent stays home with the kids. The other parent has a great job making $160,000 per year. They file their taxes married filing joint, and they have 2 kids under 18, but not under 6. The main wage earner contributes $20,000 per year to their Roth 401k. They contribute $6,000 per year to their health savings account, known as an HSA. I'll discuss both of these in more detail in a future episode, so don't worry if you don't know what a Roth or an HSA is. They pay $4,000 per year for health insurance before tax out of their paycheck, and they pay their medical expenses from their HSA. They bought their house 10 years ago and recently refinanced, so their mortgage balance is only $350,000 at 3.5%. They live here in Bedford, and their real estate taxes are $10,000 per year. They're moving along the giving path and give $10,000 a year to their church, which is 6.25% of their gross income. Since they live in New Hampshire, there are no state income taxes. Based on this example, their FICA and Medicare taxes are $11,000 deducted from their paycheck. Their take-home income is therefore $8,125 per month. I won't read the slide to you, but these are all the deductions that we just mentioned that come out of their paycheck. This next slide is going to show their expenses. So remember, we have $8,125 a month of income. You can look at all these expenses, see how it fits into your situation, but generally, a lot of people have these same categories of expenses. They save $500 a month for emergencies and a replacement car. Their mortgage payment, including real estate taxes and homeowners insurance, is about $2,500 a month. Total monthly spending, all of this is $7,600 per month. Since their income is $8,125 a month and their expenses are only $7,600 per month, they have an extra $525 a month to save or spend. Their goal is to eat out 4 times a week, which will cost about $1,300 a month. They currently spend $500 a month on dining, so this is an increase of $800 a month. What are their choices? They don't have that $800 a month. They can cut $800 a month from this spending. Other options are to change jobs to something that pays more, add a side hustle, which is a new way of saying part-time job. I have the stay-at-home parent get a part-time job, or change one of their other goals. In general, you can do anything you want, but you can't do everything you want. Prioritize your goals. A recipe for success. Let your values drive your spending. Many of us let chaos drive our spending. Change this. The wise store up choice food and olive oil, but fools gulp theirs down. Proverbs 21:20. Don't be gulping your olive oil. Little known fact. Your rate of savings will impact your future wealth more than your rate of return. This is super important. Your rate of savings is more important than your rate of return. We have worked with a lot of people over the years, and the most frugal, it doesn't matter what their income is or was, the most frugal people have the most money in retirement. Take control of your future. The reverse of savings is spending. Reducing spending is the same as savings. Tech tools. I love EveryDollar for tracking spending. This app is put out by Ramsey Solutions of Dave Ramsey fame. There's a free option, and the paid version is part of a Ramsey Plus subscription. It's simple. The only ads on it are for Ramsey offerings. It allows you to tell your money in advance where to go. It's really not complicated. It's 1 month in a little encapsulated episode, so you can just start right now and look at next month, October, and input in where exactly each category you want to spend your money. It's very good as a budgeting, hold yourself accountable software. Another option is Mint, which is free, owned by Intuit, the maker of QuickBooks, Quicken, and TurboTax. Another option is Personal Capital, also free, owned by a giant robo-advisor. They'll start soliciting you to hire them to manage your portfolio once you have about $100,000 in investments, but the software is great. What I use an accounting software called Xero. Part of that is I'm an accountant. I like accounting software. But I also have used EveryDollar. I choose Xero, an accounting software, as it doesn't show my updated investment balances daily. It's not important to see the daily changes in your portfolio, and this can be very detrimental to your mental health as well as your investor behavior. You don't want to be checking those investment balances too often because it might make you want to take action, when the best choice is often to do nothing, which can be very hard to do. Doesn't matter what software you choose. It should be the one you will consistently update with your expenses. By tracking your spending using a software like Mint, Personal Capital, or Xero, that's Xero, Xero, you will also track your net worth. What is net worth? What you own minus what you owe equals your net worth. This is the starting point on your financial journey. How can I track this? Software packages discussed above, or Excel, or a piece of paper. A financial planner can help. A good planner will also have a software package that generates a net worth statement, or at least help you create one. Let's go through a net worth example. Another busy slide. So this slide lists the value, this hypothetical couple that we discussed before. It has the value of their car, their house, their bank accounts, their investments, their 529 plans, their health savings accounts, HSAs, minus their debt, their mortgage, their credit cards, their car loan balance, their student loans. That equals their net worth. So in this hypothetical example, because they don't have a whole lot of debt other than their mortgage, and they have a house that's appreciated over time, their total net worth is $346,000. Most of that is their house. What if your net worth is negative? In the example above, if they had $250,000 in student loans and $60,000 in car loans, their net worth would only be $61,000. If the real estate market falls and the value of their house drops down from $600,000 to $500,000, their net worth becomes negative. Do not panic if you have negative net worth. You need to know where to start your financial journey, and the starting line is your net worth of today. Don't panic. A lot of people start with negative net worth when they first start figuring out what their finances look like. And they had no idea they had negative net worth. But once you start listing everything down, then it's just math. It is what it is. You need to know where to start your financial journey, and the starting line is your net worth as of today. When you are making your net worth statement, make sure you list out your debt as the total amount of debt that you owe, not your payment. So it doesn't matter that you pay $600 a month for your car loan. It matters that the balance as of today is $22,000. The car loan balance should be on your statement. Your student loan balance, you should be able to log in and see what those are. And again, this is not payments, these are the actual amounts that you owe. What about balancing my checkbook? What is reconciling your checkbook? This is simply matching the transactions on your bank or credit card statements to those in your accounting records, whether that's a paper checkbook or financial software. Almost all software solutions allow you to import transactions from your bank to track finances. You still need to enter all of your checks written or payments made if you want a real-time bank balance. Relying on your bank balance instead of your check register is how you bounce checks. Also, you won't find an error if you don't reconcile. For example, I'll go through an example. If I have a starting balance of $1,000 in my bank account, I wrote 2 checks, one for $100 and one for $500. I paid the credit card electronically, that was $400. Therefore, my balance in my checkbook is 0 in the bank. However, the check for $500 didn't clear right away, and if I relied on my bank balance, I would think I still had $500 in the bank. As most people's bank accounts have many more transactions than that, this is how you can get into a situation where you're bouncing checks and incurring bank fees of $35 per check bounced. I have seen people who really can't afford it, paying $400 a month or more in bank fees, in bounce check fees. This is avoidable if you keep track of the transactions coming out of your accounts. And you don't have to use software to do it. You can do this manually, just keeping a running balance in your checkbook, just deducting every single check you write, ATM withdrawal or debit that you make on your debit card. Other tips. Set your credit card alert text for charges greater than $1. Then you'll receive a text every time you charge something. You will immediately know if a charge is real or if your account has been compromised because the timing is very close to when the charge occurred. This can be a little funny when you forget that you did that and you're at the grocery store and you're buying groceries and you're getting texts going, oh, who's texting me? And it's Chase. Another tip is, mistakes can happen. Double charges, incorrect amounts, these are easier to catch if you're tracking your transactions. Otherwise, you're not going to notice them. And also, if you don't have that credit card alert set up to $1, you're not going to remember, did I make that charge at $52 at Home Depot? What was that for? It was a month and a half ago. How do I remember? I can't remember that. But if you have the text alert set up, then you get it instantly and you were just there, so all is good. I've caught a few funny, fraudulent transactions this way because they always start small, like $3 at some Dunkin' Donuts in Florida or something. Another tip is to decline overdraft protection on your bank accounts so you avoid bank charges for bounced checks. They just won't pay the bill. Now, you could get a penalty by the bill company, but hopefully it won't be as high as what the bank would charge you. Do you have enough? Having enough is not necessarily a number. It is a state of mind, and everyone is different. Some people have more money than they will ever need, but they're still afraid of running out. Others don't have nearly enough, as they didn't factor in the rising cost of living into their planning. I've had clients who retired with a net worth of $500,000, including their house, and clients who feel they can't afford to retire even though they have a net worth of over $10 million. It mostly depends on your goals. How important is it for you to retire at what standard of living? Everything is a choice. If your only source of retirement income is Social Security and your savings, and you only need to spend $20,000 a year on top of your Social Security, then you may be able to retire comfortably on a $500,000 nest egg, assuming an appropriate asset allocation to stocks. We'll talk about that more on investments in a future week. If you need to spend $100,000 a year on top of Social Security, then you need more like $2 million to be able to do that. We'll talk about this in much more detail in class number 3, retirement. I have found that if you are grateful for what you have, you're more likely to be able to make do with less. Being grateful for what you have and satisfied with your life can lead to real happiness. Sometimes we get caught up in society's more, and don't realize there can be happiness with less stuff and more gratitude. The other benefit to living on less now is that you need less in retirement. If you've reduced your lifestyle now, you just need to replace those expenses, which are less than what your lifestyle used to be. So it's a self-fulfilling prophecy. Also, when I meet with clients and they tell me, can I afford to retire? I look at what they have in their assets and I say, well, how much do you need to spend? And they tell me, and I say, well, you can't retire if you're going to spend that. You can't afford to retire now. But if you're going to spend this, you could retire today. And sometimes that's enough for people to take stock of their life and change how they're living. When God gives someone wealth and possessions and the ability to enjoy them, to accept their lot and be happy in their toil, this is a gift from God. Ecclesiastes 5:19. Expense problems versus income problems. Are you able to save 20% or more of your income every month? If not, you may either have an expense problem, you spend too much, or an income problem, you don't earn enough. I've seen hundreds of personal cash flow statements, and I can usually quickly identify where line items look out of whack for the client's situation. For example, I had a client couple who spent $48,000 a year on groceries. That's $4,000 a month. When they realized how much they were spending, they were horrified, as while being healthy was one of their values, they didn't value it to the tune of $4,000 per month. When they realized how much they were spending, in another situation, I worked with a couple who ate every meal at a restaurant. Their food bill was also very high, but their net worth could support it. That is, if you have a $10 million net worth and you want to spend $50,000 a year on dining, go for it. For the rest of us, if we want to achieve our goals, we should probably watch our spending on dining. If you have a spending problem, you need to track your spending. What if you have an income problem? If you don't earn enough, there could be several reasons. Several possible issues may be: you may be underemployed for your education, you may be undereducated, you may be lacking technology skills. Possible solutions: networking to meet people, volunteer opportunities to get yourself in front of people and show off your work ethic, skills, and talents, side hustles, pizza delivery, Uber, a tutor, handy person work, consulting. You can learn almost anything online for free these days. Thank you, YouTube. Start your own business. There are lots of tax opportunities for business deductions. It doesn't have to take much capital, depending what you're doing, but beware of the self-employment tax, which we will discuss next week in our taxes class. What if you make so much income that you feel stuck in your job and you're suffering from high stress? I sadly see this a lot. I suggest you go back to your values and revisit them with your spouse, and then see how you can change your goals to match your values and ultimately reduce your stress. Generosity. If one of your goals is generosity, you may be wondering how to fit that into your spending. How do you fit in your income taxes, your 401k contribution, your health insurance? You just do. They're auto-deducted from your paycheck, so you don't really miss them. Make the first transfer or check from your income every paycheck your charitable donation. You can set this up on autopay. Personally, I don't. I get more satisfaction out of hitting that button to transfer it every 2 weeks, making the transfer in line with my paycheck. Live on the rest. What if that was all the income you had? You'd make do. It's sometimes helpful to remember that everything we have comes from God. We are only the stewards. Debt. You may have heard the terms bad debt and good debt. Bad debt includes personal loans, credit cards, expensive car loans. Good debt, student loans used to finance high-income employment. Mortgage, low-interest, fixed-rate real estate loans, low-interest car loan on a car that it is affordable compared to your income, that is used to generate the income. Work to eliminate your bad debt at the start of your financial journey. Otherwise, the payments on that debt might hold you back from achieving some of your other goals. Should I pay off my mortgage? Interest rates are low, so I get this question a lot. The math will tell you no. You may be able to earn a higher return by investing your money over the long term. However, this ignores risk and the fact that past performance does not predict future results, so you can't guarantee that you're going to earn more in the stock market versus paying down your mortgage. Two popular finance radio show hosts are Rick Edelman and Dave Ramsey. Maybe you've heard of them. Rick Edelman says, no, do not pay off your mortgage. Take out the biggest mortgage you can afford at the lowest interest rate and invest the difference. Dave Ramsey says, yes, get rid of all debt so you have the freedom to save and give like no one else. What is right for you depends on your goals, values, and financial circumstances. There is no single answer for everyone. Homework. Put together your financial blueprint, aka your net worth statement. List all the things you own minus what you owe. Again, use the entire balance due, not the monthly payment. You may find that helpful to have with you in week number 3 when we discuss retirement planning. Obligatory Dave Ramsey slide. If you have a spending problem or a too little income problem, then the Ramsey Plus program may make sense for you. And no, I'm not being paid to say this. This has helped a ton of clients. It has helped me. I can't recommend it enough. You may have heard of the baby steps. Baby steps 1 is to put together a $1,000 emergency fund in the bank, scrap and save until you've got $1,000 saved up. Baby step 2, pay off all of your bad debt, your credit card debt, basically. If you line up all of your debt, except your mortgage, in balance order from smallest to largest, then you pay the minimum payment on all of the larger balance debts and put all your extra dollars to that lowest balance first. So if you owe $500 to one credit card and $2,500 to another credit card, you pay the minimum payment on the $2,500 debt, and you put all your extra money to the $500 debt until it is gone. Then you have no more minimum payment on that. Now you will have more money to throw at the next in line. Now in the Dave Ramsey program, they don't care what the interest rates are. This has worked successfully for a lot of people. It's called a debt snowball. Having tunnel vision and focusing on a very specific goal makes this program very successful. No debt is freedom to give and invest like no one else. I personally don't agree with all his advice or anyone giving the same advice to every single person in every single situation. But if you follow his advice, you're going to be in great shape. The Ramsey program puts out a ton of free advice on his radio show, his podcast, social media, his website. I also have purchased some of his books to hand out today if you were in the audience and you are interested, and I strongly encourage you to come to a future episode because there will be book handouts at all of these seminars. I do have a client that used the Dave Ramsey program to pay off a $50,000 home equity loan in 8 months by using every dollar and focusing on spending every dollar toward their goal. Dave Ramsey is very big on the debt-free scream on his radio show. People come in from all over the country after they've paid off all their debt, and they're like, yay, I paid off $300,000 in debt in however long. It's great. It's very inspiring, and especially for people who feel like their finances are overwhelming. His program is great because it really gives hope, because there are people just like you that have turned their life around. And so I find his program kind of inspiring, and I've recommended it quite a bit. This next slide is just a stages of financial planning information. If you've downloaded the slides, you can peruse it at your leisure. We're going to be talking about most of these topics over the next 6 weeks. Taxes teaser. Next week, we're going to discuss my favorite topic, income taxes, estate taxes, and gift taxes. And yes, there is a tax consequence. There might be a tax consequence if you give assets away. Almost all financial decisions have tax implications, as I've said over and over and over. We will also discuss ways to substantially reduce your lifetime income taxes. You may find it helpful to have your 2020 completed tax return handy for next week's discussion. Now we will pivot to questions and answers. Are there any questions on what we discussed today, such as net worth, budgeting, generosity, debt, balancing your checkbook, etc.? Please enter your questions into the YouTube chat, or if you're in the audience, you can raise your hand. Thank you all very much for listening to me, and I hope to see you all again next week. Thank you. Okay, questions? Yes?
You mentioned that you recommend saving.
Oh, will we have a microphone, Sean?
Hi, thank you for doing this. You mentioned that you recommend saving 20% of your income each month, and I'm wondering if that is including retirement saving or if that's in addition to retirement saving.
That's an excellent question. That really is in addition to retirement savings. Are there any other questions? Yes, in the back. Oh, we need the microphone.
So Jen, I was just wondering if you had any suggestions, if we're talking to our children about finances, how much of our personal financial situation should we share with them?
That's a really good question. Now, you don't want to make your children anxious, and it also depends on the age of your children. But you also want to get your kids off to a good start in life. So I'm big kind of on honesty. So letting kids know certain things. Like, it's helpful at some point for them to know that you're not perfect and that you struggled in a certain area. For example, oh, when I was your age, I got into trouble with credit cards because they were giving them out like candy to college students. And but I worked, over the years to get it under control, and I don't want you to go through what I went through, is just one example. Now, if you're in a negative net worth situation, or you're feeling overwhelmed with your finances, what I find can be good is going through the process with your kids. Is if you're always listening to the Dave Ramsey stuff in the car, from the podcast in the car, they'll start to hear it and internalize it. And he gives the same advice over and over to various people in lots of situations. And you can sometimes, again, you can really relate to some of those situations. And so can your kids. So I find that helpful. If you need help talking to kids, the Ramsey program does have a teen program, but I found that my teens were like, no, not doing that. So, which is fine, but they pick up osmosis from other things. And so you don't have to, even if your finances, maybe didn't get under control till later, till your kids were older, once your kids see that you've made a change, they will know you've made a change because, no, I'm not buying the $75 pair of jeans from Abercrombie and Fitch, and this is, and having them pay for some stuff, I think, is also helpful for them to learn financial responsibility. But no, I wouldn't sit down with them and go through every last dollar of your assets and liabilities because, depending on their age, but that's not really appropriate for, kids that are under, 20, unless you have an elderly situation. Elderly parents is another situation. But, we'll talk about that one more in estate planning. Any other questions?
Hi, Jen. Do you have any tips on paying for college?
Oh, that's a good one. So I already had the E for estate planning and triage, so we don't have an education E. So we don't actually have an education seminar on this. But save early, and it really depends on your income. So if your income is below a certain point, your kids are likely to get financial aid for college. But if your income, and I don't know the exact dollar amount, so I'll probably get them wrong if I try to speculate. But it depends how many kids you have in college at the same time, how much aid you get. And the aid is oftentimes loans, not necessarily grants. So that's not helpful. So I suggest saving early and often. When your kids get ready for college, I would have them apply to many schools. I would not, if they're set on going to NYU for, psychology, I would sit down with them and I would say, okay, let's look at how much this school is going to cost, and let's look up psychology degrees and see how much you can reasonably expect to earn, and then compare them. And if it's not comparable or it's clear that one side isn't going to equal the other, then maybe you should consider a different school for that topic. I really do kind of discourage people. It's very easy to get super excited about a college, but you kind of have to go into it with low expectations and say, look, don't get your hopes up. If we can get it, first of all, you have to get into the college. Then you have to figure out if you can pay for the college. There are some colleges that are going to want you across the country, but it might not be your top choice. So going through and applying a lot of places and seeing what your packages are. You also will have to fill out the FAFSA, and this gets into a lot of complicated questions. We could have a whole seminar just on this. Maybe we should. Are there any other questions?
I have a question.
Yes.
Great job, by the way.
Thank you.
So there's a lot of apps like Venmo, Cash App that are out there, and I see a lot, especially young people, that publicly put out there exactly what they're spending money on, who they're sending money to. Is this something you would cover in a future thing, or what are your feelings on that? I know what my feelings are as a cybersecurity person, but what are your feelings on that?
So I use Venmo. I love Venmo, but I have my security settings to private, or whatever they call private in Venmo land. So nobody can see my spending. But, and that's what I recommend people do. I mean, social media, we've all seen it every day. It's very dangerous to put a lot of your personal information on social media because they collect that, package it, and sell it. And then there's always bad guys looking at your page. So whatever social media you use should be mostly private in general, if you're a person, not a business.
Not just that. What I like to say is, if the service is free, then you are the product.
Yes, excellent. Just so everybody, make sure everybody heard
They
that.
are getting information from you to
Yes.
sell and use.
That is absolutely true. And don't ever respond to those Facebook things. What are your favorite, I don't know, whatever. Where have you been in the country? I'm like, that is fraud, just waiting to happen. Passwords are made from that. I don't know, you're going to be hacked someday. Stay away from that sort of thing. The other little cybersecurity advice I have is I shred everything, all that junk mail that comes in. And it used to be, they used to put your social security number on it, or on your credit card statements, have a full credit card statement number. But now they don't do that too much anymore. But I would absolutely shred all that stuff. I don't know why I'm holding this. I haven't written anything. Put that back.
So Jen, one more question.
Yes, go.
College education, do you recommend 529 plans?
Yes, absolutely. We love 529 plans. So now what I don't do is, it isn't necessarily the right decision to use your state's 529 plan. What we do is we evaluate all the 529 plans and pick the one that we like the best based on fees. We're big fans of low fee. Based on the asset allocation, some 529 plans in the past haven't been diversified. They haven't, in my opinion, had enough options to make a diversified portfolio. You can do set it and forget it age-based plans, certainly, and doing that's better than doing nothing. But you have to watch the asset allocation and the age of your kids. And I have particular thoughts on particular strategies. Different advisors will give you different advice. Some advisors love the age-based plans. I personally don't like those because I think they get much too conservative, much too early. What I prefer to tell clients, of course, you have to have means to do this. So again, this is not all advice applies to everybody. But if you can save in a brokerage account at the same time you're saving in your 529 so that you have choices, and when your kids are like 15, 16, you start saving cash. Everything stops going into the 529 account, and you're just stockpiling cash, cash, cash. Because once you're 529, if you go with one of the age-based plans, then the 529 is going to be almost all cash and fixed income by the time they're 16, 17, which is too conservative, and you're paying higher fees in a 529 plan than you can pay on your own. Granted, it grows tax-free. Also, I like the tax-free growth for stocks, which tend to grow at a higher, quicker rate than bonds. We get into this a lot more in the investments talk that we're going to have. But if you're going to do that, again, choices. So I like to have taxable brokerage accounts to take money from, 529 plans, and cash, or even just two buckets, cash and the 529 plan, because you're aggressive in the 529 plan and the cash is just fixed cash. But it also depends on what else is going on in the world, and what's happening now is a little different. And it's been happening before with higher inflation, can hurt the cash return. So it's a very complicated question that the client and the advisor would have to work through together.
So I guess, what is the risk, you save in a 529 plan and then your child doesn't go to college?
Oh, excellent question again. So when you take out distributions from the 529 plan, if that was for education, for college education, room and board, or like supplies like a laptop, for example, then it's 100% tax-free, no problem. But if your kid doesn't go to college, that doesn't mean they're never going to college. So you can, you have a few options. You can save it for them for another day, just leave it there. You could transfer the balance, the beneficiary, change the beneficiary to another sibling. Or in some cases, You may be able to transfer it to another generation, but that could possibly involve gift taxes and estate tax ramifications. So you want to be careful about that. But those are options. And lastly, you could just take the money out anyway and pay the penalty and taxes. So I think it's a 10% penalty. But good question. If you have multiple children, I would say the risk of a 529 plan is low. But with one kid, that can be tough, especially because you're supposed to save when they're born. So how do they know what they're going to be when you're born? You have no idea. Sure, just if you're watching on YouTube, or I don't think are we doing Facebook questions? Oh, Facebook questions and YouTube questions. If you type in the questions in the chat, then we will get them here and can answer your questions. Right, so the QR code, we're going to put the QR code up again so everybody can download the slides. Not here, actually, online. Sorry. Yes? Oh.
So I have a question about where to save your savings. So until recently, I was the type of person who was dealing with various debts and paying them off. And now we've moved into more of a savings,
Great.
like a long-term savings
Yep.
kind of thing. And we haven't decided to do anything except keep it in our checking account so far. You said something about like a brokerage account, and I don't know like even what the options are. Like I don't even
Sure.
know what question to ask about where to park new savings that we're embarking on.
So I can help you with that. So it depends on what else you have set up. For example, we recommend everybody have an emergency fund in a savings account. I prefer the high yield savings accounts, the online banks such as like Ally Bank, Capital One Bank, Synchrony Bank, there's others. And they tend to pay higher interest rates, all tied to current interest rates, which are all very low right now. But as interest rates rise, the interest rate will rise. So I'm not a fan of locking up your money in CDs just because I don't like my emergency fund locked up. But you're supposed to have 3 to 6 months in an emergency fund like that. Once you have that, then you can move on to, that's 3 to 6 months of expenses, by the way. Then you can move on to investing. So before you get to investing, have you maxed out the retirement plans that are available to you? And again, we're going to talk about this more next week under taxes, but do you have a 401k? Does it have a Roth option? Is the Roth option the best option for you, or is the regular 401k the best option for you? If you're under 50, you can contribute $19,500 to your 401k, whichever it is, Roth or regular. If you've done that, if you're over 50, you can contribute $26,000. So if you're not doing that, you should up those. If your income is low enough, you may be able to contribute to a Roth IRA in addition to your 401k. A lot of people don't realize that there is an income limit on contributing to a Roth IRA, and if your income is too high, you can't for that tax year. So that's another option. Until you have maxed out those, I would not save in a taxable brokerage account. But let's just pretend, for the sake of argument, that you're under 50, you're putting $19,500. Let's go back to our couple, the married couple where one parent stays home and the other parent works and makes $160,000 a year and is putting $20,000 in their Roth 401k. Let's have them put the maximum, they're under 50. Oh, so they can't put $20,000. Bad example. They can only put $19,500 in their Roth 401k. But they're already maxing that. So, and because they make $160,000, I'm pretty sure that's under the Roth limits. They change every year. I always have to Google them. So they can also contribute to the Roth IRA. So we would put the full $6,000 or $7,000. Is the limit $7,000 for a Roth? Yes, $7,000 for this couple who is under age 50. So they're putting $7,000 in their Roth IRA. They have an HSA, which they're already maxing out. They're already putting the $7,000 in that. So now they've done all of that. Now they can open a taxable brokerage account. And I will say to a client, how much extra do you have? I might have a client that has a lot of stock options. This is where this generally comes up because they make the 160, but then they get this stock award because they work for a big, huge company, and that ends up in their bonus is like another $40,000 or $50,000. And if they do that, then we can take that stock award and we can use that to fund their taxable investments. Since there's been a ton of volatility in the markets lately, what I like to tell people is to stagger that over time and dollar cost average it in. Even though mathematically, math tells us you should invest when you have the money, behavioral finance tells me it makes people nervous. So it's worked very well where we'll say, hey, you got $50,000, let's do $5,000 a month or $10,000 a month until it's all invested or what have you. And then, so if you have extra money, that's how I would handle it. I hope that answered your question. It was a really long answer.
More questions, but I think there'll be future.
There will be, we're going to talk about a lot of this stuff in future episodes. Next week, taxes is going to be very dense and complicated, but I am going to try to explain a lot of the concepts and the words that you hear all the time, but you don't know what they mean. So try to help people understand those. And then the retirement planning one in the following week is going to be pretty interesting. Also, we're going to go through an actual can I afford to retire calculation and how much do I need, et cetera. And I want to just remind everybody then that everything to do with your financial situation is really particular to you and your risk tolerance. So not everybody, there's two things when investing. You have to have the risk tolerance to be able to, you have to be able to afford to take the risk, and you have to be able to stomach the risk. I do have some clients that tend to look at their statements a lot and can't really stomach the ups and downs. So advice for them would be very different than some of the advice we just chatted about, because it really depends on your personal situation. Are there any other questions? Okay, well, thank you for coming. Thank you for watching, and I hope you will join us next week. It's going to be fun.